It's so outrageously obvious, it almost sounds stupid to big money. Take a listen to what Tom Lee just said about markets.
What I think are 5 things that are working this year. I don't want to talk about all 5, but to me, we know that technology and FANG, including NVIDIA, are working because of AI. And I think that's also pulling up, the miners and Bitcoin because they are kind of correlated trades. The second thing that seems to be working are things that are related around Ozempic and reducing weight loss because of the productivity benefit to workers. But to me, the third, maybe most interesting, is small caps. We think there's 50% upside this year. They're trading at 44% of the price to book of large caps. So I do think that's really one of the sleeper stories this year.
Tom Lee still believes a 50% rally is coming this year for small cap stocks, which that would put the Russell around 300, or if you track the Russell 2000 with IWM, that would be quite an impressive gain from today's levels in a not very long amount of time, about 6 months until we're at the end of this year. Now, why is this so simple? It's outrageously stupid. Big money tends to think you gotta overcomplicate things. Here's what's going on right now. Big money is saying you should only own big tech and names maybe that benefit from AI, whereas the same logic they're using to justify that, earnings growth and resiliency and the economy staying strong, is the same reason why small caps will likely outperform going ahead over the next 6 months. If the economy indeed does not go into a recession, which is the consensus by big money, if rates do start to fall in that environment, that is very good for small cap stocks. Now, the other aspect to also take into consideration, there's clearly 4 quarters in any year, okay? The first 2 quarters on a year-over-year basis were heavily reliant on big tech earnings growth. So even the current quarter that we're in, most of the S&P 500 earnings growth is coming from big tech, but that is set to shift to your mid caps and your small caps on a percentage basis coming in Q3 and Q4. So Q3 and Q4, you're going to see 9-10% EPS growth, whereas big tech is going to be looking at on average around 5% EPS growth. Now, small cap stocks have also been the ones that have been deemed, again, interest rate sensitive, but economically sensitive. And a lot of big money has said, well, we don't want to own economically sensitive stocks, but the economy's strong. At the same time is their argument. That to me just doesn't make a whole lot of sense. And if the economy is strong and it's going to stay strong and we do not go into a recession, small caps will start to do a lot better. Also worth mentioning, even on a relative basis, clearly small caps have not done anything for years. Your all-time high for the Russell, for IWM at least, was $236.84. Just to get back to that level, that would be upside of about 15% from here. And it could run a lot more than that. I think justifiably, as rates start to go lower, it'll be pretty easy to break all-time highs. So even on a more conservative forecast, the Russell hitting new all-time highs by the end of this year seems pretty conservative to me, as long as, again, we do not enter a recession and, inflation does continue to fall. And we'll talk about that in just a moment. That is still 15% upside, even if you just bought the IWM ETF, which you're not going to get another 15% out of the S&P and the NASDAQ unless you get a broader market-based rally from here. Big tech is fully valued. And when you're looking at this or thinking about this on a pendulum here, think about big tech, okay? What's priced into big tech with valuations where they are, where, the stocks are where they are at all-time highs and much higher than that? There's a lot of good news priced in. It's not a lot of bad news priced in. Okay, great. If those stocks continue to perform and deliver, fantastic. That doesn't mean you have to have some kind of, implosion. That's not what I'm calling for here. If anything, I think big tech will do well. Just small caps will do better. Now think about small caps. there's a lot of bad priced in and virtually no good priced in. So as the markets start to realize the economy's going to do okay, maybe. I mean, that's tentative. We'll see what happens here. Most recessions, by the way, happen because of a central catalyst, like the Great Financial Crisis, the dot-com bubble, right? These recessions in recent history, the Rona, they tend to happen because of something. And I don't know when we go into recession or when we get that because of something catalyst. That's really a topic for another video. But again, assuming the economy stays strong, I think there's way too much bad news priced into small cap stocks. And I think you can start to get this pendulum that swings more to a neutral and then actually start to price in a lot more good things for small caps as rates start to fall. Now, I should preference this with the S&P 500 tends to fall 23% following the first Fed rate cut. But basically every time the Fed has cut rates in the past, besides a few select instances, it's because the economy is weakened to a point where it's almost certainly going into a recession. That's why stocks sell off 23% on average following the first cut from the Fed. Again, it's been a long time since we've had high inflation, that the Fed has needed to raise rates this aggressive as they have. And we really don't know what is going to happen. If anyone sits there and tells you they know with certainty how the markets will react when the Fed cuts rates, they're lying to you, okay? What I can sit here and tell you is if the economy is doing okay or good, and the Fed is able to cut rates because inflation is falling, that is a very, very bullish recipe for small cap stocks. Because one, when the Fed cuts rates, it lowers your borrowing cost, which a lot of small caps and mid caps do a lot of borrowing, unlike big tech. And that's a reason why, again, big tech has been outperforming. They don't need to borrow money. So these higher rates actually benefit big tech, and their cash piles just allow them to collect free interest for basically nothing. But what rate cuts also do into a good or okay economy is lower the odds of a recession, which small caps are very, very tied to the business cycle. So if it looks like you're going into a recession, small caps are going to do really bad. If it looks like you're entering into a boom economy, small caps are going to do really good. Well, every rate cut we get from the Fed, whenever they start, I think by July 31st, it lowers the odds incrementally that we will actually go into a recession. So there's actually two positives when the Fed cuts rates that are, obvious. Again, a lot of the time, big money doesn't talk about that latter part, right? When the Fed cuts rates, it lowers the odds of a recession. Most people don't say that outright, and that's why I wanted to explain that here in this video. Now, inflation really is categorized with two things at this point: insurance and rents. It's only a matter of time before rents come down to the market value of where they are. Not the price of rents, but the growth in the increase of rents. It's calculated via owner equivalent rents, and that's really just a bad way of doing things. If you look at harmonized CPI and PCE, you're already at your 2% target. That's like how Europe calculates their inflation. So we just calculate inflation on very dated, very, very outdated metrics for this new economy that we're in. So it's only a matter of time before housing falls. And I think, again, as Tom Lee said on Friday, even if the Fed starts to cut rates a little bit, that's going to compress the gap between mortgage rates, and that could also have a positive impact on pushing lower rent inflation. Because how it works, I'm a licensed real estate agent, is that you have the 10-year treasury at, let's say, 4.5%. Just to make round numbers here. What brokers will do, and lenders, they'll go add 3% to that right now. So that's why you're getting a 7.5% mortgage. Typically, the spread is like 1%, right? So you add, let's say, 1% to the 10-year treasury, boom. That's where you get your mortgage rate. Sometimes it can be even less than that, maybe a half of 1%. But right now, it's insanely high. And that's why mortgage rates are as high as they are, because they're adding 3% to the 10-year treasury yield. Well, when the Fed starts to cut rates, that could start to fall a lot more. If the Fed cuts rates by, one cut, maybe that spread falls 50 basis points. Maybe it's only 2.5% higher than the 10-year treasury, which would put mortgage rates all of a sudden at 7%, right? And then you could start to see that really get reduced. You could have 5% mortgages by, 2025. And that will also help the housing inflation picture. Now, you also have auto insurance, which specifically has been very high. And there are reports from Geico and others, JP Morgan, Morgan Stanley, and Goldman Sachs have all made reports on auto insurance and how that should start to fall as well in the second half of this year, because auto insurers are becoming profitable again. And then the third component of inflation that I think should be mentioned is oil, specifically commodities, but really oil. Oil affects every business anywhere, okay? Because you're shipping products, you're doing services, you're driving somewhere, it doesn't matter. It's an input cost to all businesses, which lead to companies inevitably raising prices. So when oil falls, like you have seen a 10% fall in oil in the last month and a half, that also tends to be pretty positive on bringing inflation down. Now, Tom Lee has talked about this many times in just the last couple of months, but especially as rates start to fall, this $6.3 trillion in money market funds is going to have a choice. It's going to have a choice to go back into other areas of the markets that could give you a larger return, or this money is going to have a choice to lock in their yields in longer term treasuries, which if they lock in their yields in longer term treasuries, what does that do? Well, buying pressure on treasuries pushes down yields. There's an inverse correlation. Selling pressure pushes up yields. Buying pressure pushes down yields. So if they start to lock in, 10-year treasury bonds, for an example, at 4%, whatever the yield is at the time, then the more and more you start to see that, the more 10-year treasury yields will actually start to fall. And then a good chunk of this money is probably going to go into equities. And where is that money going to go into? Well, probably not your big tech as a huge concentration. It's probably going to go into an equal weighted fund, because equal weight should start to outperform. And depending on what is outperforming at the time, let's say July 31st, if we get the first cut from the Fed, that's where a lot of the money will be allocated. So if small caps are outperforming by July 31st, if Wall Street gets really bullish on small caps by then, and hopefully, again, we get the first cut by July 31st, then more of this money market fund coming over to markets will get allocated into small caps, into interest rate sensitive, into mid caps. If AI is the buzz by July 31st, then more money is probably going to go into AI than small caps. I would just argue that probably by July 31st, you're going to get a lot of enthusiasm into your small cap stocks. And it wouldn't surprise me if the Russell is at all-time highs by July 31st. If, again, we do get the first cut from the Fed, we're going to have 2 more inflation reports, 2 more reports of basically all of your economic data besides GDP by July 31st. And you're going to be approaching almost another one. So you're going to have hopefully 3 inflation reports that are declining, data reports on the economy showing the economy is doing okay, but not red hot. Hopefully the labor market's doing okay by then as well. This should give the Fed enough room to cut rates in July. I will also tell you this is not priced in by the market. So for July 31st, there's a 10% chance of a cut and an 89% chance of a continued pause. I think these odds start to flip over the next, let's say, month and a half or so, where the odds of a cut become a lot stronger, and then eventually the markets will start to price in the cut July 31st. That, again, back to the pendulum kind of example that I was making, you're pricing in a 10% chance of a rate cut and a 90% chance pretty much of a continued pause. As that starts to shift, you can start to see a lot more capital get allocated into areas that will benefit from that. Right now, a lot of big money is saying it's too early to go into small caps. It's too early to go into interest rate sensitive stocks. I think inflation, if it starts to or continues to fall, I think people's confidence is going to start rising that the Fed's going to start cutting rates soon. And maybe it's not too early to get into small caps, mid caps, basically your Russell 2000. And if you just look at the markets on a risk to reward basis, like what's likely to give you the next 10% higher or lower from here? Well, let's just say higher. Do you think the S&P is going to go 10% higher from here? Or do you think the Russell is going to go higher from here? After everything we just explained, inflation falling, maybe the Fed cutting rates this summer, it's clearly small caps. On a risk to reward basis, it makes a lot more sense to be in small caps right now. And big money hasn't realized this. And when they do, well, that's where the big gains will come. Even on a technical basis, the Russell 2000 has been hitting higher lows ever since you did hit this low October of 2023. So actually the technicals for the Russell still look very good. And it actually looks like you could be breaking out here soon. Even over the next couple of weeks. The next level I would target is about 220 on the Russell, which is this median level that you traded at back in late 2021 and the early part of 2022. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already. You guys have a fantastic rest of your day, and I will see you in the next one.